Hello out there, everybody. Professor Martin here, and I've got an accounting video for you today. In our video, we're going to look at dividends, and we're going to talk about how to account for them and the important dates involved when a company sets a dividend. So we're going to look at Cedar Fair as an example. Cedar Fair is the parent company to Kings Island, located in Mason, Ohio. And if you have been following the news right now, everything's closed. All the entertainment venues are closed because of the COVID-19 pandemic. So if we look at the stock price for Cedar Fair, it's been on quite the downturn over the last couple of weeks, simply because people don't know when they're going to be able to open, how long they're going to be able to open, and that kind of thing. We'll all be eventually able to go and enjoy all the theme parks, but right now, who knows when that's going to happen. If there's one thing investors don't like, it's uncertainty. So that uncertainty has absolutely hammered Cedar Fair stock. As you can see, from a high of about $65 all the way down to $13. We had a little bit of a bounce back in the last couple of days. So all of that put together has created a crazy dividend yield. Look at the yield on Cedar Fair, 23.93, nearly 24% dividend yield. So a dividend is simply money that a company has earned that it's returning to the shareholders in the form of a cash payment. Now, normally dividends are made quarterly, so that amount you're looking at, $3.74, it might be divided up into 4 separate payments that equal that total amount. But the idea is for every share of Cedar Fair that you own, you're going to get $3.74 for that share. And you might say, well, that's a big deal. $4, that can't even buy me a latte at Starbucks. But if you have hundreds or thousands of shares, a lot of people, that's how they fund their retirement days, is dividends, income from stocks, and that kind of thing. So what we want to look at is, how does a company account for that dividend? How would Cedar Fair go about doing the accounting when they declare that $3.74 dividend? So let's jump in here. I'll make a little Excel spreadsheet. We can kind of walk you through what's going on. There we go. And we'll just kind of assume that we only have one share. If you just kind of want to picture that the number that I'm putting up here, the 374, is stated in millions or whatever it might be. The reality is Cedar Fair is going to book an entry for $3.74 times however many shares they have issued and outstanding. So here we go. The first date we need to know in the payment of a cash dividend is the date of declaration. The date of declaration is when the company's board of directors says, hey, we're going to pay a dividend, here's how much we're going to pay, and here's when we're going to pay it. Now, when a company declares a dividend, they are at that point in time legally liable to pay that dividend. They are on the hook for it. So we're going to book a payable. The first thing we're going to do is we're going to debit retained earnings. If you think about that definition of retained earnings, earnings retained by the company. So retained earnings is the cumulative net income that's been retained by the company. When we pay a dividend, we're waving goodbye. Goodbye, earnings. We're getting rid of you. We're giving you back to the shareholders. So it makes sense that we would need to debit retained earnings when we declare that dividend. So I'm going to put in 374. Again, the way we calculate that total number, the amount of the dividend times the number of shares that we have outstanding. So my credit, I'm going to put in a payable, dividends payable. Like I said, at that date of declaration, I am legally liable to pay that dividend. You have to look back pretty far to find an instance where a company got out of paying that dividend, and usually the only way they're going to get out of paying it is if they go under. I can think of Enron as being an example. Enron declared a dividend, huge accounting scandal broke right after that, and they ended up not paying that dividend because they were no more. All right, so the second date we got going on is called the ex-dividend date. So on that ex-dividend date, we don't really have to do any accounting. That ex-dividend date is more for the investors to know who's going to get the dividend. If you buy the stock on the ex-dividend date or any day after, you're ex-dividend. You're not going to get that dividend. The shareholders who own the stock up to that ex-dividend date get the dividend. Okay, so that ex-dividend date for Cedar Fair March 3rd, 2020. If I don't own the stock before that date, I don't get the dividend. Okay, so whoever owned it on the 2nd, they're the people that are going to get the dividend. On the 3rd, it goes ex-dividend, meaning dividend without. And if you bought it on the 3rd, you're not going to get that previous dividend. You have to wait till they pay the next dividend way down the road, the next quarter, the next half year, whatever it might be. So nothing really going on there from a bookkeeping standpoint, the ex-dividend date. One thing I will point out, if you're just thinking, oh, well, I've got a great scheme, I'll just buy the stock right before they pay the dividend. I'll collect the dividend and sell it. I like your thinking. I'm always up for a good scheme myself. But if you look, those ex-dividend dates are kind of baked into the stock price. I'm going to pull up the stock chart for Cedar Fair over the past 5 years. And if you see the D, that's every ex-dividend date for that particular stock. And if you'll notice what happens on every ex-dividend date, notice how it goes down a little bit on every ex-dividend date, for the most part. So there's another little bump down there and going down, going down. So basically that idea is baked into the stock price. You'll see that when it hits ex-dividend, most of the time the stock price is going to dip a little bit. Normally it'll come right back up. But if you're thinking, man, I'll just buy stock right before the ex-dividend date, get my dividend, then dump it, it's not quite that simple. Wish it was, but it's not quite. So we have our date of declaration. We got our ex-dividend date. The next date would be the date of record. We're going to see a memorandum entry. You can't tell, I don't know how to spell memorandum, so I'm just going to put a memo entry. Our memorandum entry doesn't really involve a debit and credit. It's just basically going to say when we're going to pay the dividend, and it's going to go to the stockholders of record as of whatever date. Then finally, the date of payment. We get rid of that payable that we had set up, and we credit the cash account. After that, it's all done. We just kind of wait until the next time we declare a dividend and begin that process all over again. So those are the events in the life of a cash dividend. I'm going to make a few other videos to show you that there are other kinds of dividends that a company can declare. They can declare a property dividend. They can declare a stock dividend. And I'm going to walk you through a few problems in which a company does a different type of dividend than a cash dividend. But just kind of keep in mind, the cash dividend overwhelmingly is the most common type of dividend. If you have any questions, I'd be happy to help. Just send them my way, and we'll see you on our next video.